Go, guys. Well, first off, I want to thank everyone for joining us. This has been a great little start to this. I mean, everyone's cameras on, talking, communicating. I mean, not what I expected at all, but obviously love the engagement from the beginning. So hopefully we have this throughout the presentation. So this is Syndications Made Simple, presented by Bull and Bear Investments. I am Austin Kinchin, and along with my partner, Mitch Miller, we make up the Bull and Bear investment team. Just as a quick disclaimer, we are not tax experts, financial advisors, or real estate lawyers. So in the preceding slides, it's strictly our opinions. We recommend that if you do proceed or do continue on with an investment, similar to the one that we're describing, that you do talk to the experts that you seek advice from in those areas. So with that, I think we'll start off with a question. And the number one question we get at Bull and Bear is who is Bull and who is Bear? And to be honest, we don't really know, but here's a picture for you guys to determine who you think is who. And all I'll say is my kids affectionately know Uncle Mitch as a big teddy bear. So with that, we can keep on rolling. So here at Bull and Bear, we have three pillars that we really pride our company on. And the first one is passive cash flow. Here we really strive to help our investors grow in both their financial and lifestyle goals through investing in cash flow producing real estate assets. For me and Mitch both, this is what attracted us to the real estate industry. It's what we were seeking as we started to build our own personal portfolios. And even as a father of 4 kids, 3 of them being girls, I need some way to unleverage or to leverage my time and untie my money from my time, because I've got a lot of weddings to pay for here in the future. The second one here is being trusted partners with our investors. We believe that being a wise investor means you understand what you're investing in. We're obviously passionate about real estate, and you can tell through the tonight, like education is very important for us. We say here it's the cornerstone of our company. Mitch and I both were fortunate enough to have mentors who poured into us and gave us education, and now we look to pass that along to our investors and back into the industry. I would encourage you guys, we've got the chat open here as we go throughout this deck. If there's questions that come up, this is really intended for you guys and to help you dig into areas that may be of uncertainty or have questions about. The last piece we have here is we strive to create individualized portfolios for our investors. Investors come to us with a variety of different goals. We try to help them achieve those goals through a diversified class of assets, right? So we're not just planning on pushing, one particular multifamily asset, but we try to include a variety such as short-term rentals, mobile home parks, and even storage facilities, which each offer unique advantages to an investor and specifically what they're trying to do. So this right here, guys, is just a quick snapshot of our achievements to date. It's not intended to be sales pitchy or braggy, but obviously we want you to understand where our experience and knowledge has come from. Bull and Bear started in 2019, and you can see from the stats here what we've done to date. And this, once again, is just to show you, that we do understand what we're talking about and has come from experience in deals like these before. So with that, I'm going to turn it over to either the Bull or Bear, depending on your interpretation of that picture. My partner, Mitch Miller.
All right, thanks, Austin. Yeah, so really jumping in, why me and Austin picked real estate. We just found the most advantages to help us grow our wealth and kind of get to where we want to be in life. That's one of the unique things about real estate is that, it has a ton of advantages that come with it. Typically, when you look at investments, they might have a few advantages, but really what we've found is that real estate has all of them. And so looking at these, from cash flow, to being an inflation hedge, really, we just see it being a great asset. And so we hope that throughout this presentation, we'll hit on all these. But like Austin said, if there are questions that come up about any of these, feel free to pop them in the chat. And we will have some question and answer at the end too. So if you want to save them for there, we can do that as well. So truly just jumping straight into what a syndication is, really there's 3 main parts. Who in the syndication, and really all it is a group of investors that pool their resources and experience together to buy an asset and execute a business plan. The what really syndications can be for anything, we talk a lot about apartments, but like Austin touched on, we've seen short-term rentals, mobile home parks, there's commercial real estate that's syndicated, mixed use. And we've even seen vineyards and other businesses that have been syndicated before.
Yeah, the vineyards is one that me and Mitch passed on early on in our investment career, and Mitch likes to keep that wound fresh. So I appreciate you keeping that one in there, Mitch.
And then just how it's done. Typically, a syndication is a business plan, and that business plan has a variation, right? So it might be a value add business plan or an appreciation. It could be a long-term buy and hold. There's also debt deals, right? So if it's more like fixed income where it has a set return and you'll get that. So at a high level, that's what a syndication is. So what are the pieces of a syndication? We say meet the players here. On the left side here, we see general partners. General partners are the active part of the deal. So they're going to find, raise, close, manage, and make sure that the deal is run properly. So they're going to do all the work. They're going to find the deal, like it said, and look at the business plan and see what opportunities there are. And they're the ones that are going to execute on it. Jumping over to the right, we'll have limited partners or LPs. Really what they are is they're the passive side, right? They're going to bring the capital to the deal. And so what they're going to do is they're going to do due diligence on the syndicator and the deal itself and make sure it aligns with their goals. And if it does align with their goals, they're going to invest their capital into the deal. And from there, the GPs will run it. And in the middle is the star, this is the prize. We say property here, but it's whatever asset that's in the syndication, right? And so that's going to be, that is going to be the core piece of what's going to be, ran or managed to grow that investment. Typically, it's held or it should be held in an LLC. That LLC is owned by the LPs and GPs, and that way you get true ownership of it. And so, and that's legality, like how you're going to own it, and that's why you're protected when you invest in syndications.
Yeah, Mitch, I think sometimes we get the question a lot, how does a syndication differ from, say, a REIT, crowdfunding, even there's mobile apps now that are available to invest in real estate, right? So talk a little bit about that for us.
Yeah, syndications differ mainly on that piece that you're owning a true piece of the real estate. So you're getting all the benefits of the real estate. So you're getting the depreciation, you're getting the leverage, you're getting all the benefits that come with real estate. Where with REITs, you're typically getting paid out, if you know the legality behind it, you get paid out 90% of the profits. And any of us in business know that profits can be interpreted in different ways. And, as a business, you want to reduce profits as much as possible. So they're taking all that depreciation, they're taking all the gains from real estate, and they're only passing on what they're saying profits are. And so that's the main difference I see from REITs and syndications, is just having that true ownership and all the benefits of real estate.
Yeah, absolutely. Again.
So just jumping in, why are syndications good things? Like, what are the pros of syndications? To start, it's 99% passive as an LP. The reason we say it's not 100% is that you do have some due diligence you should do on the syndicator and the deal itself. We say it can and should take time. As an LP, like, this is going to be your biggest piece you want to focus on. It shouldn't be overlooked. But once you've done your due diligence on the syndicator and you start seeing their deal flow, it should get faster and faster to look at deals and see if it aligns with what you want to do or how you want to invest. And after you make your investment, right, you sit back, you collect the passive income, and you just read the updates. And that's like the benefit of being an LP in these deals. There's massive tax benefits to these deals because it's in a syndication, because the property is at such a large size. We do what's called a cost segregation study, and all that means is we bucket costs in different pieces, and we get to use something called bonus depreciation. And so on a typical deal, we'll see 40 to 120% depreciation year one, and what that means is you get to write that off on your income of the passive income. You can, if you're a real estate professional, actually write that off your active income. So if you have that tax designation, these deals can be very powerful. Velocity of money. Really all this is saying is how fast can you recycle your money? Most of our deals have a refinance in the middle of them. And so if you make an initial investment, you'll get a large chunk of that back in the middle. So you're able to take that money and reinvest it somewhere else, kind of using that money theoretically twice. And so that velocity of money really helps you set yourself apart and grow wealth in a lot faster manner than a lot of other assets. Stabilized returns. We typically are buying properties that are in the hundreds of units. And so if we have 5 or 6 move outs, that's a small percentage of our total, occupancy. Where if you look at something like a single family home, if you lose your tenant, you go from 100% to 0%. We typically see a lot of people looking at like residential multifamily, so duplexes and quads and things like that. Even taking a quad, which is the largest one, you lose a tenant, you're losing 25% of your revenue just from losing that one tenant. Where with our asset and the size that we deal with, we can absorb a lot. And so what that does is it really stabilizes our returns. So we can have predictive cash flow, and you as the investor can have that as well. With preferred returns, what that means is, these investments are aligned for the LPs. Preferred returns just means that the LPs get paid before the GPs. We typically see things like an 8% preferred return, which means you get the first 8% of the return of the asset before the GPs see $1. And so really it does align goals to make sure that, the GPs are doing what's best for the investment for all the investors and not just themselves. Really because of all that, historically multifamily and syndications have outperformed the market. Especially now with the market being down, we do see that, these are standing up a little bit better.
Yeah, I think this is one that, especially right now in this current climate, Mitch, to your point, with most of our investors' portfolios being down north of 30%, they're really enjoying being uncorrelated to that market and just the stability these types of investments are providing them right now in a time of instability.
Yeah, absolutely. We kind of touched on this, but at a certain point, once you've done your due diligence and after you've seen a couple of deals, like you should be able to kind of rapidly go through deals. It shouldn't take you very long to look through the deck and the investment slide and make sure it is something you want to invest in. Another thing we typically see, like as a big benefit for our investors, you're leaning on a team of experts. Real estate's been a hot topic for quite a few years now, and everyone kind of seems to want to jump in. And a lot of people get scared on just not knowing what to do or how to get in. And syndications are a really good avenue because you're leaning on people that this is, typically their full-time job, or they've done multiple deals. And so this isn't their first rodeo, and you get to lean on their expertise and kind of come along for the ride. The last two kind of tie together. Again, in syndications, there's non-recourse loans and you have liability protection. So we kind of touched on that the asset sits in an LLC. So you're always 100% protected on anything that happens at the property. If someone slips and falls, like you have no worry that it's going to come back to you as an investor in the deal. And the non-recourse just means that, if for some reason the worst case happens and we get foreclosed on, you are never out any more money than what you put in the deal. So you're kind of protected on your downside of just losing your initial investment.
Yeah. And guys, while we're on all the good stuff, before we get to the bad stuff, I just want to pause for a quick second because that was a lot of stuff we just kind of pelted at you, and just open it up. Do we have any questions regarding any of these terms or any further clarification around any of this stuff? No, pretty good. Okay, awesome. All right, Mitch.
I paid him not to ask any questions because I was so good. So, like Austin said, those are the good, and we want to lead with the good. There are cons, right, with everything. So just knowing, what the cons are here on syndications. The number one thing, again, is vetting syndicators, right? Like I said, it should can and should take time from you to do, because, this is where you're doing your due diligence, and you need to make sure that who you're parking your hard-earned capital with, is going to take the best care of that and be the good custodian. And so that can take time. That can be, hard to do. We will actually have a couple of slides on, some things to do to help, with that process, but that's definitely something that can take some of your time. LPs are passive, right? And we said that in the last one was a benefit. And this one, it is a con, because with passive comes lack of control, right? You are the capital and you're putting your money with the GPs and, those experts, and they're kind of driving the deal. So, if things don't go as planned, you don't always have a lot of levers to pull to kind of go in and help the deal. You always have access to the GPs, right? There should be communications on a steady cadence, but the things that you can do are typically limited as an LP. It is an illiquid asset, right? So it's not a REIT, it's not a stock, it's not something you can just buy and sell on a whim. You are locked in for the business plan. So, our typical deals are 5 or 6 years. And so if you do get into the deal, it is a non-liquid asset. And so there's not a market for your shares and things like that. So it is locked up.
Yeah. And look, no matter how many times we say this or harp on it, we always get the question, well, what if there's an emergency? Like, is there some panic button that we can push to kind of eject out of this thing? And so, Mitch, do you want to speak to that just kind of briefly?
Yeah, we definitely try to help, and we definitely have had instances where, investors needed their capital back for an emergency. It is a case by case basis, but, we have had, a good luck on getting people to buy their shares. Now, it doesn't always happen at par. It gets tricky because if you took some of the tax benefit, we're getting kind of deep now, but it is possible. But I wouldn't bank on it. If you're going to invest in this, really make sure that it's money that you're not going to need, during the time frame of what that asset's supposed to be.
Yeah, I would say we're trying to avoid it at all costs. Yeah, thank you.
Yeah, deal life cycle. Again, a lot of these rely on being a passive investor. A lot of, we have some investors that, do tax planning, right? And so, people will invest quite a bit of money in syndications. And if the business plan says they're going to sell in 5 years, right, they might plan things to absorb that sale and those gains. But as always, the GPs are looking out for the best interest of all the investors as a whole. And so, recently we've had really good luck of exiting deals early. So we've had deals that sold in 2 years for the 5-year pro forma, or what we're expected to make in 5 years. And while that sounds like a bad con, right? But it does cause some people headaches with their taxes, right? So if you were to sell things or get into make moves with your finances, expecting not to have a sale in your syndication, and it happens, right? It can throw a wrench in things. So you are at the kind of the mercy of the GPs. And the last thing is the GP fees, right? We typically see splits around like the 70-30 mark on it, like apartment syndications. While that sounds like a lot, again, you have the preferred return, right? That 8% is paid to you first, and only anything above that is split 70% still to the investors, 30% to the GPs. And so, me and Austin only work with people, that we feel have fair fees, and we'll talk a little bit more about fees, in a few slides. But me and Austin always invest next to our investors as an LP as well. So we have the same shares as everyone else in the deal. We would never, be a part of a deal that we don't want to invest in as an LP. But know that there are fees, right? There are going to be things that the GPs get paid for because they're at active side. But we feel like it's a very fair trade for their expertise and what they're doing in the deal for the return that they get.
Yeah, and Mitch, and one thing on the fee side too, this isn't a fee that's taken up front or anything, right? Like you're not paying for that, like it just comes out of the return, right? So very similar to financial advising fee, right?
Yeah. So jumping in here, another heavy slide. They will get lighter, I promise. But here we just wanted to help, everyone on the call, like if you're new to syndications, like what to do or what questions to ask or how to even evaluate, what kind of syndicator is right for you. And so we kind of broke them down in 3 parts here. The first being experience, making sure that they've done a full cycle deal, right? That means they've purchased something, they've done the business plan, and they've exited the property. Really, you learn things at every step. And one of the biggest eye-opening things for me was in my first syndication, part of the GP team, they were set on only renovating 90% of the units. And I was like, why would we leave 10% of the units? Like we're talking, we're leaving money on the table, right? These are things that we can help, raise our investors, returns even higher. What they told me was the only people that buy $20 million properties are other investors. And so if you squeeze out every drop of return in this investment, like you're going to sit on the market forever and your investors' returns are going to start to dwindle, right, as you hold longer and longer. And it's just really eye-opening to know that these people have so much more experience and they know what they're doing. And so if you work with a syndicator, that hasn't gone full cycle, there are going to be gaps in their knowledge, and that's going to be something that, you're going to maybe pay for. And so really having, your syndicator have a full cycle deal, have a full knowledge for the entire thing is very important. The next thing here is really, track record, talk to their investors, right? Ask about their past deals, ask to talk to their investors, and one of our favorite conversations we have with, teams that we're going up with, or going to sync up with is like, what happened on your worst deal? How'd you handle it? How'd you communicate with your investors? What was your path forward? And really seeing what they do when things go bad, right? Because it's not when things are good that you worry, it's when things go bad. And so, those are the good questions to ask. And then the last 2 kind of go together again. It's conservative underwriting and, a solid break-even occupancy. And again, those are going to be harder to do as you're new. but at a high level, when you look at the numbers, are they expecting the market to be better than it is now or worse? We always build in that the market's going to be worse when we bought it than when we sell it. And so we're building in, it's going to be a harder market. We're not going to get as good of a valuation as when we bought it. We see a lot of syndicators that will do the opposite. They think it's going to get better. And it was kind of funny for me in Austin, we would look at these deals, in the last few years, the real estate market's been red hot. And so to underwrite that things are going to get better was just silly for us, and, things that we always looked out for.
Yeah. That goes hey, Mitch, sorry, we had a question pop up here in regards to kind of what you're speaking to. And Shane asks, when they're looking to verify syndications groups and what they tell them, what's the best way about going about that? Obviously, what we've talked about a little bit, but he asks about documentation and just kind of standard practices.
Yeah, that's a great question. I guess if you trust the verify is a solid thing. Things I could give you would be updates, right? If they've actually ran through a deal, there's going to be monthly updates they should be able to send you. I don't know if you depending on if they could or couldn't maybe send you the financials, especially the deal's closed. There's really nothing proprietary or secret. So I have all over financials of closed deals that I could send over and show you. But really, you could even do hey, what you bought it for and what you sold it for. Those are all public knowledge. So there are things that you could do as well, all to kind of verify their story if you feel like they're maybe feeding you things that aren't true.
Yeah, and Mitch, one thing too, we mentioned here about conservative underwriting. Underwriting is typically done in an Excel file, right? I mean, it gets very granular and into the weeds, but depending on your appetite for that or what kind of advisors you have to help you analyze that kind of stuff, that's something you definitely can ask for from syndicators as well too.
Yeah, and you're always, and you should be able to, any syndicator, just call them up and be like, hey, walk me through the underwriting. Tell me, these certain things, and they should be able to walk you through it and have a good story about why they feel that way. And if they don't, that's a red flag. So, you should have, again, trusted partners in the space because you're going to be parking your hard-earned money here and trusting them. They should be able to walk through the numbers with you if you do have questions. And I don't think we touched on break-even occupancy, but pretty much what that means is, don't make sure that they're not leveraging the property so high that they need to have 90% occupancy to cover the debt, because that leaves very, very small margin of error. If things go differently or if there's a big move or, the economy changes, right? And the wider that gap, the more room you have for error and the more room you have for profit. And so, just make sure that they have that there. Fees, again, make sure that they're in the standard range. Again, different asset classes have different fees, but typically what we see in apartment syndications, there's a 70-30 split and an 8% preferred return. So just make sure that they're there. Watch out for additional hurdles. What that means is, like I said, so the first 8% goes to the LPs, and then they might be our next hurdle where it says, hey, if we make 12%, it goes to 50-50. And what we feel is it's just not fair for the investors that park their cash to have their returns diminished as things get better, right? The GPs are getting paid more, after that preferred return. We feel like that's enough. And so, GPs make their money on they're not necessarily changing the rules if things go really, really well. So we just feel like the hurdles are things to look out for. And then refi and sale fees, we don't work with anyone that has them. So, some syndicators will take 2% of the loan on refi, and they'll take 2% of the sale fee off the top before things get split. We just, again, feel like it's kind of something that shouldn't be done, right? It's taking away from our investors and things like that. And it's just should be part of their split that they're currently getting and not additional fees. And then the last few here is just more things that, are going to come across a little bit more personal. So, syndicators are going to fall into a certain category. They should have like a segment or expertise. And so, as you find what you want to invest in, make sure that the syndicator does the same thing. So if you're a value add investor, then make sure they do value add, right? If they're appreciation, debt. So just make sure there's alignment there. Communication frequency, a lot of frustration from our LPs come from just communication. And so just asking those questions up front, making sure that if you want monthly updates, you get monthly. Some investors are like, they could care less. If they got their checks in the mail, they don't necessarily care about the updates. Other investors would like weekly calls if it was possible. And so just making sure that you have that alignment so you're not getting frustrated with your investment. Open to share knowledge is really where me and Austin kind of found our pillar of being that trusted partner. We've worked with a variety of syndicators, and like Austin said, we're lucky enough to find some that really did open up and share knowledge with us. But we've had some that had an just like a level of arrogance that they thought maybe they were better than LPs or didn't have the time to kind of walk through things because they were busy and they were managing the property, and that never rubbed us the right way. And so, if that's something that's important to you, just ask those questions. Like Shane said, walk through the underwriting, like see what they say. They should always say yes, right? Because you're going to be a big part of the deal and helping it close. And then the last two is just, again, it's truly that personal feeling. I always like to ask them the question, would I do business with these people outside of real estate? If they come to you with an amazing deal, like that's awesome. But is it something you want to build a relationship with? Is this someone you want to be in business with time and time and again? And then that gut feeling, right? Making sure that you're fully aligned with what you're doing. Because again, you are going to park your cash here. And typically it's not a small amount of cash. And so you want to make sure that you're fully okay with what you're doing and where your money is going before you do it.
Yeah, guys, another pretty dense slide, as Mitch said here. So just once again, before transition, Shane, thank you for your question. I want to once again just pause for a quick check-in. Any questions here from the attendees? No? All right, on we go.
2 for 2. And then once you've done your syndicator, due diligence, again, it kind of falls down, right? So you'll be joining their deal flow list. You'll be getting deals. That's where this comes in. And so this is going to be what you're going to kind of walk through when you do like due diligence on a deal. So investor goal alignment, the time frame, right? Some deals are 2 years, some deals are 6 years, some deals never sell. There's all these different variations, like what makes sense for you and your goals, and just make sure those align. Like don't invest in a deal that never sells if you want to buy a new house in 5 years, type of thing. Returns, right? There's debt deals that pay 8%, and there's deals that are telling you that you're gonna make 300% in 5 years, right? So just make sure that those are there. Obviously there's caveats there, and make sure that you're okay with the risks that come along with those returns. And that kind of goes with the next one, right? It's like looking at it a full package. Like, do you feel comfortable with the returns they're going to offer you? Do you feel comfortable about the risks they're taking, the projections they're making? My favorite is like looking at the comps they send you, and looking at like where they want to push rents and like in the area, like are there other apartments that have those rents? Are they comparable? Me and Austin have done due diligence on deals where it's a garden store, like 2-story garden apartments that are looking to get $1,800, and the only comp that has $1,800 is a 30-story building with a pool on top. And it's like, it's just not comparable. And so looking at those things really can help you understand if it's a good investment for yourself. And the last thing here is, talk to the parts of your team, right? Maybe talk to your CPA. If you have a financial advisor that understands real estate, it's good to have other opinions as well. So just cross-referencing with your team there. And then again, the asset, where it sits, and the business plan and the asset class. So, if you feel like the Southeast is growing, a lot, and that's where you want to invest, if a deal comes across your plate from the syndicator that's in Michigan, maybe you pass, if it's not going to meet your goals. The business plan, right, is a value add appreciation. Just make sure it's aligned with what you think is going to be the best return for yourself. And then asset class. We didn't touch on this much, but, there's A, B, C class and D class, depending on where you want to be with your investments. Just make sure it aligns with that.
Yeah, I think one comment here, Mitch, by no means, if for example, you guys were ever to receive a deal presented by us, we're excited, we're passionate about this stuff, and so we're always going to be, not pushy, but really into the deal. So it's very important that you have your hard lines drawn in the sand here, where, like I said, if the risk profile doesn't match what you're looking for, hold firm, don't give in, right? Like these are the things that ultimately are going to make sure you're in the right assets for your goals and your financial, well-being.
Yeah, absolutely. So here is just a typical timeline of syndication. A lot on this slide, so I'm gonna kind of go over pretty quickly here, just hit the high points. On the top, we see what the GPs are doing, or the active part of the deal. And on the bottom, we have the limited partners. And a quick caveat here on the LP number 1, it's pretty much getting introduced to a syndicator. And really what we suggest is you do that as soon as you know that syndications are something you want to do. There's not a a better time than now to kind of make those connections, because most syndicators are going to have deal flow and different deals. And so the sooner you can get in connection with them and do that, the better for you, the more deals you can see. And so, but we, putting on the chart here, we put it on week 1 here. But as you can see up top, the GPs are really looking at the markets, figuring out what markets make sense, building a team, getting the financing in order, doing the underwriting, do the due diligence. And once they have most of that stuff, they'll produce like an investment packet and send it out to the investors. And that's where you see the LP number 2, right? You'll receive that like investment summary. And that's where you get your first peek at like what the deal is, where it's at, what it's trying to do, what the business plan is. And then you get to conduct your due diligence, right? You can look through the underwriting, you can ask questions, you can do those things. And it's typically about a month to 2 months, that window where you have the opportunity to invest if you'd like to. And like Austin said, really hold firm, because, there might be some follow-ups or questions, reaching out to make sure that you got the deck or you have questions. So just making sure all that's good. And then, once you've done your due diligence, if you decide to invest, right, you wire the funds into the deal. The GPs would then close on it. And then that's where the fund starts, right? The GPs will manage the deal, start to execute on that business plan. And you guys get to sit back, or the LPs get to sit back and cash those checks that come in quarterly. And so, that's really the rewarding part. And then eventually, right, will be a refi, hopefully, and then a sale. And both those moments, you'll just get larger checks. And at sale, right, it'd be closing of that LLC, which are final K1. And that's kind of the syndication timeline.
Yeah, I think one thing to call out here, Mitch, if you look for the investor side, between 3 and 4, at this time, the GPs are working to close the deal. And so just like anyone who's ever purchased a house, right, there's a down payment that's required to be able to close on the house. So, as you are having conversations with syndicators and talking about committing to a deal, just keep in mind that they are trying to calculate where the closing funds are going to come from, right? If you come up short, you don't get to close on the deal. So I would just ask from a GP side, like just take that serious. And if you don't want to be in a deal, just a no is better than a maybe and a we'll see, and keeping people dangling. And so you might feel a little bit of pressure from a GP because they're just making sure the funds are in. And once again, I hope you never feel as an investor or pressure from a GP or like they're trying to sell your closure real hard. But just realize if you ever sense that might be a little bit of where that pressure is coming from, just making sure things are all lining up for closing.
Yeah, it's a very good point, Austin. So here, this is going to be a typical, a practice run looking at what returns would be on one of these deals. So this is actually taken straight from one of our deals we closed on late last year. And so this is a very common layout that we see. So looking at the investor returns, we see down at the bottom here, we see 20% average annual return. And really what that's doing is looking at the $100,000 or the $201,000 return under the totals, that last column. We can see that that's about 100% return divided by 5 years, right? That's where you're getting like your 20% average annual return. 12% plus cash on cash. We're kind of getting in some financial terms, but all that means is what's the yield on your cash that you're getting, right? So everything here is in increments of $100,000. That doesn't mean it's the minimum. It's just made for people like Austin that aren't very good at math, to kind of easily look at like the percentages and break it down. So using that, you can kind of see here. So year 1, you see 7% cash on cash return, which means you're out of that $100,000, you're making about $7,000 in return. Going through those years, right, you can see it goes up. You can see a refinance in year 3. And you can see that cash on cash spike, right, because you got half your cash back. And so now you're making yield on half the amount of money. And that's kind of where that additional bump in cash on cash return goes. And if you park that cash somewhere else, right, you kind of have that snowball effect. IRR 17%. And then the 101%.
Whoa, hold on. You're gonna, first off, Mr. Math Wizard here, unpack IRR for us, please.
Yeah, IRR is a little bit more of an advanced metric. Really what it's doing is he always calls me out on IRR because it's a terrible metric, but it's a good one if you're really into finance. But all it's doing is it's putting a weight on the time value of money. So if you have a bigger return in the beginning, it's saying, hey, like your money's getting more money faster, so it's a better return. So that's typically at a high level what IRR is. If you really want to dive into it, I would suggest maybe looking it up because it's a pretty complex math problem to kind of get there. So thanks, Austin. But yeah, so then this deal, right? Say it again, bud.
So just got to keep you humble,
Yeah. But our typical deals, right? 5-6 years, 101% return, right? You can see that by that total of $201,000 back on a $100,000 investment. And again, here we can see those tax benefits. So we use a company called Madison Specs to do our engineering report to see how much we can write off. And in this example, we're getting $62,000 off a $100,000 investment. And so this is really where that tax benefit comes in, because a lot of this cash flow is going to come back to you tax-free because you have this big write-off. And the good thing about this is, you're able to take that write-off, and if you don't use it all, you're able to kind of roll it forward. So you don't lose it. It's not a use it or lose it thing. And it sticks with you until you do use it. So that's a pretty big benefit here.
So Mitch, real quick, so $62,000 in passive loss seems pretty phenomenal, but what can that be applied to? Is that stock gains? How do they take advantage of that as an investor?
Yeah, so the IRS buckets costs in 3 main categories. So you have active, and so that's anything you trade time for money for, typically your W-2, any kind of 1099 things that you trade time for money for, that's the active income. You're not able to write off that. Again, asterisk, unless you're a real estate professional. If you're a real estate professional, then you'll be able to write it off your active income, just additional things. So if that's something you think you qualify for, I would highly suggest you talk to your CPA. The second bucket is portfolio income, and that's stocks and bonds. And so this is a big thing that a lot of investors don't understand right away, is you're not able to write this passive loss off on stocks and bonds, right? Because that's considered portfolio income. What you can do is any other passive income you have. So if you're in multiple deals or if you own real estate passively, you are able to use this deduction against that. And so that's a good question to know exactly where, this can be used.
Yeah, well, I've got an even better one for you from Timothy. And he wants to know, does this passive loss impact the 100K limit from the IRS?
No, it doesn't. So I think what you might be talking about is, and again, I'm not a CPA. I can just tell you, we have investors that write off way more than $100,000 a year off of our cost segregation studies that we do in our deals. I don't know the $100,000 limit very well, but I know with passive real estate, you can write off like $3,000 up to $3,000 off of your active income. Yeah, I'll tell you, I can't answer this question with enough expertise to even try to give you an answer, but I can just tell you we do have investors that take more than $100,000 a year. So I would say it does not use that limit, whatever.
Yeah, he did clarify specifically for real estate investment losses. Yeah, this is where, look, we're doing our best here, right, from education standpoint, but to Mitch's point, by no means are we tax experts. I do know, Mitch, too, right, there is some income level that if you're below, you can claim some of the depreciation, right, against active, right? But once again, those are conversations that we would recommend having with the CPA.
Yeah, and so that's kind of a typical deal, and so it's where I go first, right? Like, let's look at the returns. If the returns aren't good, I'm not going to dive into the underwriting. So this is a typical walkthrough of what we typically see.
Yeah, Mitch, did you mention minimums typical for our deals?
Yeah. So typical minimum of a syndication is anywhere between $25,000 and $50,000, sometimes higher. But we always do say, right, like if there's a deal that you're really interested in that you don't have the minimum for, always ask the question. A lot of times we can accommodate, investments under the minimum, but there are certain limits that we have as a syndication on how many investors we can take of a certain type and things like that. And that's why the minimum moves. So if it's a smaller deal, typically we can have a lower minimum. If it's a larger deal, typically it's a higher minimum, just because we need the bulk of our investors to come in at a certain point. But that said, always ask the question if you want to in a deal, and the minimum is a little bit too high. So, typically we can accommodate. So just to wrap up here, what syndications are and are not. We'll start with are not. They are not REITs and they are not crowdfunding. Things like Fundrise and things like that. Like you're kind of getting paid a dividend or even interest, and so it's very tax inefficient. There's never really nothing you can write off to that, where in syndications, you have true ownership of real estate, you're getting all the benefits of it, you're getting all the tax advantages. It's not liquid. Like we said, we're buying a very large asset that does take a lot of time to even move, right? Even selling it takes months, for the other people that are buying it to do their due diligence things. So even if we were moving to sell it, it takes time. It's very illiquid asset. These will not be executed flawlessly. We read these, you'll see these beautiful investment packets that are sent out to you guys, and you'll be like loving it. We're going to add a tennis court and a pool and all these things, right? And we're going to bump rents to X amount. I'll just tell you that there are always going to be bumps in the road. It's just how business is, right? We're projecting something that's 5 years down the road. I couldn't tell you, exactly where I was going to be 5 years ago to today. So just know that there are going to be some deviations from that, and just be understanding, right? At the end of the day, we're just working towards those returns in the best way we can. And so we will pivot, right? We've seen interest rates double. And so a lot of our syndications are moving to different aspects, and it's almost a benefit, right? It's something you kind of want to see, but just don't get married to the business plan, and just know that as things change, hopefully the GP team is adapting and changing as well.
Yeah, and I would say too, Mitch, it's also important not to get caught up in the now. As a GP team, we're primarily focused on the future, right? So why in the now it might seem like things are coming off, at the hinges. It's typically very small things that with hindsight, really have little impact to the overall performance of the asset, and that's ultimately what the GPs are focused on.
Yep. And then they're not fast moving, right? This is a big asset. It's manual labor to turn units. It's manual labor to find people to move in and start paying rent, right? It's a slower moving asset. You're not going to see swings like you do in the stock market, where it's moving 10 to 15% a day. Not that the stock market does, but in a week, these assets won't do that. And again, controllable. As an LP, just understand that you're trusting a team to take control of the asset, and it's really sometimes a lot of times out of your control. What they're passive, right? That's the best thing. I always tell the story. I started in buying properties myself. I bought multifamilies and acquired a portfolio. And growing up as a kid, really my focus was I wanted financial security. I wanted to be financially independent. And after amassing a portfolio of rental properties and dealing with tenants and everything else, I quickly changed my thing to financial and time freedom. And so that's a huge benefit of these is really having that passive income where you're not, trading time for money. You're never going to get maintenance or tenant calls, right? So you're not going to have the worst parts when you tell people about you invest in real estate. They're like, oh, I couldn't imagine taking phone calls from a tenant. You'll not have none of those. Uncorrelated asset, right? Now it's more important than ever. I know Austin touched on it. We are getting a lot of feedback from our investors. They're pretty happy that they're diversified, not 100% in the stock market. Really this is something that isn't moving with it. So it's a great diversification tool. Again, you're relying on more than just your own knowledge. You're relying on a team of experts that do this hopefully as their job, and they've done multiple times and they know the ins and outs of what's going on. Hard asset, typically, we don't use this term a lot, but with inflation being 8-9%, hard assets it's becoming more of a term we're throwing around as a benefit for sure. And the good thing too is, a lot of these deals have pricing power, right? So, if we keep seeing inflation at 10%, not only does the asset itself, because it's, material hard, it's a building, will go up in value, but we also can, up rents, right? On a yearly basis. So there's never going to be a time where we're 10 years down the road and haven't raised rents, right? So we have pricing power in all the assets that we invest in. Again, true ownership in real estate, you get all the benefits of that, you get all the tax advantages. So syndications, that's kind of what they are and what they're not.
Yeah, and Mitch, in that same vein, you can advance the slide here when we talk about true ownership of real estate. We've tried our best here to not only talk high level, but also give real world examples. These are real properties that Bull and Bear has been involved in. We have one of our properties from our short-term rental portfolio, a couple of them out in Texas, Birmingham. So, these are real assets that our investors are owners in across the United States. So, with that, it concludes our presentation here on syndications. I know we've kind of been peppered with questions throughout, so I want to pause for a moment to see if we have any more questions out there from our attendees.
Austin?
Yes.
Where do y'all fall in the category of the the gamut of investing? Who are y'all? What do y'all fall under the category of?
Yeah, so our team, we work as general partners or GPs in these deals. So, we specifically in our deals, we specialize in investor relations, as well as business plan execution. Those are kind of our niche, our little niches that we fall in the GP team. So when we work with other GPs in some of these deals, that's why we get called in to primarily focus on. Anything to add there, Mitch?
Yeah, I would just say too that GPs is typically a team, 5 to 7, sometimes up to 10 people. It's not just one person. It's not just 2 people. It's not just me and Austin doing everything, right? You'll have people that specialize in different parts, of acquiring the property, getting financing, doing the due diligence, doing the maintenance terms and things like that. And so the team is diversified because you want experts in each one of those positions.
Yeah. Oh, and I guess too, we should, you mentioned it earlier, Mitch, but we also fall in the LP category as well, because we do invest in all of our deals with our investors as well. So thank you.
It looks like Timothy also asked, I may have missed it, but how would we get the lowdown on your upcoming investments? Yeah, so typically we'd have an intro call with you, introduce ourselves and our strategies, really have that one-on-one. You can ask all the questions you would want. And we'll put you, kind of on the deal flow list, where any upcoming deals you'll get, insight into. You'll get emails saying, hey, we have an upcoming deal. You get the investment packet, and then you'd be able to look over it. And again, we're always available for questions, concerns, comments on it.
Yeah. And Timothy, we'll have an email that will go out after this call that will send you guys all a recording of this presentation, as well as a link to schedule any one-on-one time if you would like with us, but that way through Calendarly, so it should make it pretty easy and convenient for you guys. And then we can hop on either a phone call or Zoom call to kind of, continue this conversation and get to know each other to make sure this is a good fit for both parties involved. Mitch, one question that I've had from investors a few times is, if these deals sound so good, how come I've never heard of them before?
Yeah, they are regulated by the SEC. So all of our investments are regulated. You can look them up on the SEC website as securities. There's 2 types of deals, right? And so there's ones where, I'm going to say high level here. There's ones where you can advertise and do those. If you ever listen to like a Bigger Pockets or anything like that, or any kind of real estate fund, like, if you heard advertisements at all, like it's that. But the syndications we typically work with are smaller, and which means we can't advertise. And so it's one of those things where you need to know someone that's doing it before you're ever going to hear about it or ever see any of these deals. And really what that is, it's an old IRS law that says, if you're going to do these type of things, like they need to be accredited investors if you're going to advertise. And so they just think people that don't have money can't make their own decisions. That's my opinion of the law. And so typically why you haven't heard these is because a lot of times these deals can't be advertised because of that law. And, you're going to need someone to know someone like Austin or myself before you'd have any insight that these deals ever exist.
Yeah, Mitch, we had another question coming from the chat from Heather. Her question is, what are the price ranges of the investments from as low as to as high as?
So I'll answer that in 2 fashions. A minimum, so as an LP, you get to buy in as a minimum. 25,000 is the lowest we've seen. We've seen as high as 100. But typically the assets that we're purchasing are around the $15 or $20 million mark. And so, we're raising those funds for the down payment, typically 25%, 20% down payment plus a little bit of CapEx to get started on the renovations or whatever the business plan is. Was that that didn't answer your question? Then let me know.
Yeah, I think the only thing I would add there, Mitch, right, is, from an individual investor, what would their high end be? And the main thing typically is just keeping it under a certain ownership percentage. We've seen as high as $1 million as the high end as far as what an investor can buy in, recognizing, to Mitch's point, that percentage that we're raising is, anywhere from $5 to $6 million range per deal. Another one, Mitch, that I get every now and again is, if these deals are so good, like why do GPs give up as much as they do in the deals and not just keep them for themselves?
Yeah. Sorry, Brian, go ahead.
I said, because they need financing and they can't do it all on their own.
That's right. That's a big
Can
piece
work
of
for
it.
us.
That's
What's
a big
that?
piece of it. Yeah, so the GPs typically, we have an understanding that like we would rather have, 4 deals and have a smaller percentage of them than just one deal and have all of it. Right. So just as LPs, GPs want diversification, there's typically deal flow that happens. And so by giving up, I wouldn't even say giving up, right? It's a mutually beneficial, agreement. That's why the GPs do it. That's why the LPs do it. And really we see it as a win-win, but that's why GPs are looking for LPs for that investment, is because, yeah, they do need capital to close on deals and allows them to do more deals. And so, that's the pros of both.
Well, let me ask this question. You showed the assets that y'all have been involved in for you two, for the bull and bear. So how many syndications does that involve, and how many of them would you classify as good, how many as poor, and how many is in between?
Yeah. So
Take it, Mitch.
yeah. So bull and bear, we've done 9 deals. I think we've done 7 apartments and 2 funds. So we have a mobile home park and an STR fund that are operating. We've had a few go full cycle. I will say the one that went full cycle that's in my head was very bumpy. It was like 2.5 years, and distributions were never sent out because things happened in the business plan. But our investors eventually got paid out in 2.5 years, above pro forma. So they beat expectations in 2.5 years. But I'll tell you, investors weren't happy, right? Like they were expecting one thing, right? They're expecting cash flow, quarterly, and that didn't happen. I will say that, we have a few deals that, with the rising rate environment, like we're starting to look at like, how do we move forward? Like, do we kick off, the extra cash that we have, or do we bunker down? Because the worst thing as a GP, right, is we don't want to send out money and all of a sudden need money, right? That causes a lot of issues. And so, a lot of our deals, I would say are in different spots. But I would say the majority are doing very well. Austin and I are lucky that we like value add apartments in the BC class areas. And so we are adding a lot of value to these properties. We're not expecting the market to push it. And so if we were in A class or appreciation properties, like hoping the market continues to go up, like we'd be in a big trouble. But luckily, we are in the BC class value add where we're, flipping the units and doing things. So I would say there's one that I'm watching closer than the others. So I would say out of the 7 that are left, I would say one is probably yellow flag, and the rest are still green in my mind, to answer your question directly.
Yeah,
So
go ahead.
So is it better to diversify and put yourself in multiple syndications, or just isolate on the ones that you are pretty confident that they're going to be good, if that's even possible?
I would say that that's going to be investor specific. We have some investors that take Jeff Bezos' approach, where it's, diversification is going to keep you not wealthy, right? Like he got extremely wealthy by centralizing his investment. He was all in on Amazon. And so if you have an investment that you think is going to crush it and you don't have any doubt, like you can go for it, right? And that could pan out and you can make out really well. I would say that the common feedback we get from investment advice is diversify. A lot of our deals look pretty close to the same, right? So we have a lot of deals that look at that doubling your money in 5 years. And so for me, I would just ask the question why, if I was having a conversation with you directly, I'd ask, like, why would we want to go all in on this one and not spread it across 3-4 deals? Because you never know what happens. And, and if there's weather or if there's anything that happens, right? Like you want to diversify for those black swan events as well.
Yeah, and Mitch, just to kind of piggyback off of that comment and the one before, as we work as GPs with other GPs in these deals, we are also doing our due diligence on those syndicators, right? So, for example, the one deal that in the short term performed or underperformed, but then ultimately ended up faring pretty well for our investors. For us, as me and Mitch have these conversations about, working with GPs, and when people come to us to work with them, those are the kind of things we take into consideration, right? was this partner good to work with in the past? Did they deliver, right? Because just like you guys are evaluating syndicators, we evaluate other GPs when we determine who we're going to work with to ultimately provide more predictable outcomes that stick to our business plans.
So if I have $500,000 and I'm going to try to invest that in various investments, be it the stock market, bonds, and real estate, what is the percentage? I know it's all personal, but it doesn't fall. It's not bonds. It's not stocks. You could classify it as somewhere in between. What's the percentage I put in real estate of my $500,000? And do I classify that as risky, safe, or high risk?
You can take it on, Mitch.
Yeah, I can. Yeah, so it's considered an alternative investment, right? And so really, you're starting to leave what we call like the narrative of our financial education system, right? Everyone says like, oh, well, it's a stock bond portfolio, right? That's what we've been taught, So the little we have been taught about finances, right? That's what we've been taught is make sure, as you get older, you move more towards bonds, and you get less stocks, and make sure you invest in indices like indexes and things like that. But really, what we see is truly there's not. Like, I hate not to answer questions directly, but it's really going to be up to you, right? So sitting down with like a financial advisor that understands these alternative investments, right? I think there's always a place for real estate in every one. I would say, look at your income goals. Typically, real estate produces more income or more yield than a lot of stocks and bonds, even fixed assets like, fixed income. And so look at your needs, right? If you're, approaching retirement, you need a certain lifestyle, right? Maybe real estate can be there. And I think real estate underwritten properly in good locations with a good business plan is extremely safe. I think safer than, stocks and bonds because, you are able to pick a team, you're able to pick like a location and a business plan, and there's levers to be pulled there, right? Like we see rents are under market, and we see other places that are comparable that have higher rents, and so we know the market can handle that. And so like there are things that can really de-risk that investment, right? And there's different levels of real estate, right? Some people buy Miami condos and just hope that it continues to skyrocket. Like that's also an investment in real estate that I would consider risky, but I don't know. It's extremely hard to talk.
Yeah, look,
on like what splits should be where.
Yeah, I think you're pushing us for an answer here, and if you can remember back to one of our core pillars, it's individualized portfolio, right? And to Mitch's point, like if we were having a conversation with you as an investor one-on-one, we would answer your question with another question, and that was ultimately, well, what are your investment goals, right? And I think that's kind of what Mitch is getting at, because what we at our fingertips have a variety of assets. For example, our mobile home park has 120% depreciation play, right? So every dollar you put in, you're getting 120 or $1.20 back, right? So someone who has a very large passive income, that is their goal and that's their strategy. And so that's the approach we take. So I think, once again, to kind of piggyback on Mitch, it's just ultimately like, what are your goals? What stage of life are you in? And what are you trying to achieve through your real estate investments? Mitch, we did have one other question come through the chat from Heather again, and it says, do you work with realtors on listed apartments, or are you dealing with off-market properties?
Yeah, so a funny thing here is anything above 40 is considered commercial properties. And so we work with commercial brokers. I would assume there's been something that's been on market, but commercial brokerage or commercial real estate is like old school real estate. And so nowadays, you theoretically don't need an agent, right, to go buy a personal home. You have Zillow, you have Redfin, you have all these things. You can pretty much do your own due diligence. It's on for sale. Where back in the day, you needed an agent to know if things were for sale, right? Well, in commercial real estate, that's still a thing, right? There's not really a good place where commercial real estate's listed. And so there's a lot more things what people call pocket listings and things like that. And so we typically work with brokers, and brokers want to work with people that close. And so, we work with teams that have closed a lot of deals. And so if they get a good deal, they're calling us because they know we're going to close. We know we have the backing of our investors. They know we're going to do this. So it's not going to be a waste of their time. and they're not gonna look bad against their client that they're trying to sell their pocket listing, right? And so we typically don't do on-market deals, but we definitely work with brokers to find deals, and they give us deal flow, and they let us know like when sellers are looking to get rid of an asset or turn that asset.
Yeah, and just on the back end too, right? When we sell these properties, very similar, right? So typically, not necessarily listing with an agent, but working with a broker to close out these deals. All right. Any other questions here? We're just over the hour mark right now. I want to be sensitive to everyone's time. Quick pause. No. All right. Well, guys, I really appreciate you taking time out of your day to come and listen to me and Mitch give our spiel here on syndications. Hopefully you found this beneficial. You've got our contact information here. We'll also be receiving an email with this recording and an opportunity to schedule some time with us. As Mitch mentioned earlier, we can't advertise. And so, our business spreads word of mouth. So, we would ask that if you know someone that would benefit from this, or has expressed interest to you in real estate, or just diversifying a little bit, we'd obviously appreciate any positive recommendation or you sending them our way. All right. And with that, we'll wrap this thing up. Thanks, guys.
Thank y'all.
Thank you.
That was great. Really appreciate it.
Awesome.